Okay, so tonight we'll be covering chapter 12. There we go. Which will be capital structure decisions. So, chapter 12 outline. We're going to preview, say, some of the capital structure issues. We're going to look at business risk and financial risk. And then we're going to look at some models like the Miller model. And then we're going to look at how the effects of corporate tax and personal tax impact how firms will structure their business. We're also going to look at some criticisms of some popular models as well. And then we're going to kind of look at an evidence-based theory on, say, what is the best model, some different guidelines that are used, and what seems to work in practice. So this is more so just a reminder that businesses are valued at the present value of all their future cash flows. And it's kind of a concept that tends to carry through every chapter of this book, more prevalent or less prevalent in certain areas. So a preview of capital structure issues. Capital structure is a firm's mixture of debt and equity, and target capital structure is a firm's preferred capital structure, right? So how much are we financing with equity versus debt, versus preferred shares potentially, or short-term debt? Because that's going to drive, what our weighted average cost of capital is. So capital structure decisions is a choice of target capital structure, based on your average maturity of your debt and specific types of financing to use in any particular time as well. So some basic definitions, and we'll see this in formulas as we work our way through. V is equal to the value of a firm. We'll see VL for leveraged and VU for unleveraged value of a firm. Leverage is just basically the effects of debt. We also have the free cash flow. We have weighted average cost of capital, RS and RD. RS is the cost of stock, RD is the cost of debt, and then WS is the weight of stock, and WD is the weight of debt in our capital structure. Very high level from that previous slide, how we value a firm. Value of operations is present value of future cash flows. And then how we calculate weighted average cost of capital. When there's debt, we apply a tax effect, we take the weight of the debt, and then the cost of the debt, and then we do the same thing, but we don't do the tax implications on shares because, we can't deduct dividends, so there's no tax implication. So, impact of capital structure on a firm's value. Basically, it depends on the effect of debt on the weighted average cost of capital. The more debt we bring in, generally it'll bring down our weighted average cost of capital to a point, right, till we hit our optimal level. And then also what the impact on our free cash flow is as well, right? And specifically bringing on debt, it increases our interest payments. So there is an impact. So debt increases the cost of stock, RS. Debt holders, fixed claim, increases the risk of stockholders' residual claim, right? So the more debt that we have, the more interest that we pay. The more interest that we pay, the more it brings down net income. The lower net income is, the less residual value that is available to our shareholders, right? So it increases the risk to our shareholders by adding on more debt, which increases the cost of our equity. So debt reduces the taxes a company pays. Interest expenses reduce taxable income, right? So as we pay more interest, that gets deducted off our net income, right? To get our taxable income, it gets deducted off our operating income. And then basically by reducing our taxable income, yes, we have less income, but we also pay less taxes. So you actually get a portion of that interest back, which I'll show you how that works. And then cash is freed from payments to government. Cash is freed from payments to government to payments to the investors, right? Always remember as we're going through this as well, that debt holders are also investors. They give us capital, we generate a return in the form of interest as opposed to dividends, right? So they are considered investors, and we look at the total value that we pay to investors. we factor in interest into that as well. And then debt after tax cost is reduced because we can deduct the interest, therefore debt actually costs less because we get a portion of the interest back from tax deductions. So bankruptcy risk increases the cost of debt, which is RD. More debt, higher probability of financial distress and bankruptcy as well. And then more risky for debt holders who demand higher returns, and then increase the pre-tax cost of debt as well. So very high level, right? As you progressively take on more and more debt, it becomes harder and harder to take on more debt, right? Because it'll start impacting your profitability. Banks will be unsure if you can even handle that level of debt, and therefore they'll keep increasing the cost to basically make sure they're accounting for the risk that you'll default on that loan. So the net effective weighted average cost of capital increases in percentage finance with low cost debt, right? Decreases percentage finance with high cost equity. So and we have to think about it like this: if we bring on $1 of debt, we're basically going to have $1 less of equity for our financing structure, right? Debt has a lower cost because it's tax deductible, the interest is, as opposed to equity, which has a higher cost because dividends aren't tax deductible. So in that case, what ends up happening as we bring on more debt, right, we have less equity. Debt has a less cost to it. Equity has a higher cost to it. Therefore, it will technically bring down the weighted average cost of capital, right? But we also have to consider that the more debt that we bring in, the cost of our debt's going to increase and the cost for equity is going to increase as well, right? So in a lot of cases, the net effect on weighted average cost of capital can be uncertain. But as I will show you, at a very, very high level, for at least a portion, it will bring down your weighted average cost of capital to a point as we look at how this works in practice. So bankruptcy risk reduces free cash flow. Lost customers, reduction in productivity of managers, frontline workers, etc. When your company is not in a good position and your employees know it and your customers know it, it influences how people behave, right? So you may lose customers. You might not want to contract with a firm for 2 years to build a building if you don't think that firm's going to be around in 2 years, right? That's a huge problem for you. Same thing with your vendors. They might not want to deal with you if they think you're in trouble. They may not offer you as much credit. They might not give you any time to pay your invoices. They may require immediate payment. And then your managers also, they might become less productive or discouraged. We also have increases in net operating working capital as well. Decrease in net operating profit after taxes and free cash flow, and then reduction in the value of the firm overall when bankruptcy risk tends to overtake and overall starts to reduce free cash flow. So if bankruptcy risk affects agency costs, the behavior of a manager is affected in two opposing ways. So wasteful spending by a manager, right, is usually reduced. So when a company is doing very well and has very strong free cash flows, management can they'll start freewheeling with the money a little bit. And this can lead to some wasteful spending, right? For instance, sending employees to, large conferences, stuff like these, perks, whatnot. But when a company is more in trouble, you don't see this as much. People are much more critical of how a company is spending its money. And then we also see that a company may have positive net present value projects that would normally be accepted because they bring value to the firm, but they're no longer being accepted because the company basically doesn't have the free cash flow to finance everything, so they only take the very highest net present value projects. So the net effect is unclear, right? In some areas you're going to save money, in other areas you're going to lose opportunities. So, but overall bankruptcy risk does impact the way a firm behaves. So issuing equity conveys a signal to the marketplace. Managers know the firm's prospect better than the investors, right? So what ends up happening, and just think about it like this. As a company, right, and as an executive, would I go and sell 100,000 shares on the open market if I thought the stock was undervalued? Definitely not, right? I'm only going to go and sell equity if I think that my stock is properly or overvalued, right? So if I think the price of my stock is good right now, I would go and sell equity. And that's how shareholders read it, right? So shareholders read it as if management sells shares on the open market, they think that the stock is overvalued, right? And therefore that they know better than me because they're internal users, they have internal information, therefore the stock is overvalued and I need to get out of this. So what you'll see is usually when a company issues equity onto the open market, the stock price will drop and people will sell off the stock because they take it as a signal as the stock's overvalued, and it's a good time to get out of it, right? Okay. So business risk and financial risk, they combine to determine the total risk of a firm's future return on its equity, right? So the risk that basically the firm is going to be able to, pay its debt and whatnot, and all the other risk associated with running a business as well. Put that together, that's the risk that the shareholder does not get their required return. So business risk is a firm's shareholder would face if the firm had no debt, right? It's the risk of going into business is all of this. Sometimes things go wrong, sometimes you have really strong competitors, sometimes you just get beat, right? That's business risk. There's always uncertainty about its operating profit and its capital investment requirements, right? So there could be variability in consumer demand, uncertainty about sales prices, right? Uncertainty about input costs. There's so many different things, foreign risk exposure that impact the business and therefore impact business risk, right? Customers just might not want your product anymore. In the instance of Blockbuster, when they got beat up completely out of the market by Netflix, that's business risk, right? It wasn't a problem of cash flow at the time, really. In the end it was. That's how companies go bankrupt, but they just got beat by their model, right? And that sometimes happens in business, happens all the time in business. So that is business risk. Whereas when you have operating leverage, in this case, this is the change in EBIT caused by the change in sales measured by quantities sold, right? So the higher portion of fixed costs within a firm's overall cost structure, the greater the operating leverage. So if you think about it like this, our operating leverage increases the more fixed costs that we have, right? So as we bring on more and more fixed costs, say you're running a company with $1,000 in fixed costs. If you do absolutely no sales in that year, your loss would be $1,000, right? Whereas if you have a company that does $5,000 in fixed costs, that's the other company in the same industry. If they do no sales, they have $5,000 loss, right? So it takes that other company longer to break even with the $5,000 in fixed costs, whereas the company that has a lower fixed cost structure, they break even a lot faster and therefore they're lower risk, right? This is what we call operating leverage. So high level, this is a operating break even. So Q is your quantity sold, F is your fixed cost, V is your variable cost, and TC is your total operating cost. So when we go down here, you'll see fixed costs divided by P minus V, which is your price minus your variable cost. That is your contribution margin. So fixed cost divided by contribution margin, it gets your break-even quantity. So in option A, the break-even quantity would be 40, right, for plan A, whereas with plan B, it would be 60. And they don't really give you the numbers here, but they graph it out here. So what this looks like is this is, say, option B, where this is, say, option A, right? This company, right, has a higher level of fixed costs, as we see here, whereas this company has a lower level of fixed costs. This company is profitable much quicker, right? Because a smaller portion of their costs are fixed costs, whereas this company, it takes longer to be profitable, right? Because a larger portion of their costs are fixed costs. However, because this company has more fixed costs, their variable costs are not as bad, right? So therefore, you see the slope of the total cost line, it's a lot lower. Whereas this company is low leverage, right? So with low fixed costs, but because they have low fixed costs, their variable costs are a lot higher per unit, right? So we see this total cost line has a much sharper slope than this total cost line does, right? So with this company, it technically takes them longer to break even because they have higher fixed costs, right? But what ends up happening here is if we produce below expectations, this yellow at any point in here, yellow would be your loss, right? So this would be your loss in your operations. But once we hit our break-even quantity, our net income is now zero, and as we go beyond, our net income is positive. And the space between the two lines, our revenue line, our total cost line, this is our profit, right? So in here, a company with a high degree of financial leverage, if they exceed expectations, they are very profitable. Whereas a company with a low amount of leverage, but a higher variable cost curve, even if they beat expectations past their break-even point, you'll notice the space, the little blue space here between these two lines, it's a lot less, right? So when you have high leverage and you have high fixed costs, you have a much higher potential return. Whereas when you have low leverage and low fixed costs, you are lower risk and you tend to break even faster, but even if you perform expectations, it's not high risk, high reward, right? So your potential payout is not nearly that of a company that has higher fixed costs, generally speaking. So, and then impact of operating leverage on business risk, right? So when we talk about risk, we generally talk about, the probability that you don't achieve your required returns, right? So when we have a company with a very high standard deviation, right, in its return on invested capital, ROIC, this is much higher risk, right? Because there's a huge range of potential outcomes here, right? Say that this is the negative point and past here we lose money. Mathematically speaking, we could work this out and say, okay, there's about probably 20, 25, maybe 30% chance like we lose money. But overall, there's a 50% chance we perform less than we expect, right? Over here there's a big space between what you expect and what could actually happen. But notice there's also a massive upside here as well with the high operating leverage company. So this is just basically graphing out that total losses at zero sales are massive, but total gains at maximum sales are also huge, right? And this is showing that a return on invested capital can be very high or very low. Whereas with low operating leverage, it's much more condensed, right? Our potential outcomes, it's much tighter, it's much more predictable. So as we see here at the highest end, our operating profit is much smaller, and at the lowest end, our operating loss is much smaller. So therefore, in this case, it is our total outcomes is much less, our standard deviation is much less, therefore our risk is much less because the risk of performing below our expectations is smaller than, say, a high operating leverage company. So financial risk and financial leverage. Financial risk is the additional risk placed on a firm's shareholder as a result of a decision to finance with debt. So additional business risk is concentrated on common stockholders when financial leverage is used. So it depends on the amount of debt and the preferred stock financing as well. But as I said, right, the second we add debt into the equation, we are taking money away from our stockholders because our net income is decreasing, and debt holders have their higher priority than shareholders for getting their payouts, right? Because you have to pay interest, you don't have to pay dividends. So by bringing on debt, we directly affect the chances that shareholders get their money. Therefore, it immediately starts to increase the risk to our shareholders. So this is the effects of financial leverage, right? This is a company with no debt, and then this is a company with debt, right? So this would be, say, 200,000 equity financing, no debt financing. Whereas company B over here has a book equity of 100,000 and debt of 100,000. So we have a 50-50 split versus 100% shift to equity. So what we see over here is basically no debt versus with debt. And then the calculation of our net income and book equity. So I'm going to actually quickly work through kind of what this looks like on the board here, so that it's much easier for me to point out a couple things to you. Alright, so this is a company with no debt, and this is a company with debt, right? And I think we said no debt, which is 100% equity, and then this is a 50-50 split, okay? So, this is our EBIT, earnings before interest and tax. So we're gonna have $40,000 in EBIT and $40,000 in EBIT, right? Because earnings before interest and tax doesn't factor in interest yet. Interest is the implication of debt, right? So if we haven't actually factored that in yet, we don't necessarily have to worry about it, because there's no difference between having debt and having no debt up to this point. Now, what we do is we deduct interest, and this is when the impact of debt takes hold. So, in this case, there's no interest when you have no debt, because you don't have to pay any interest, right? But in this case, we would deduct $10,000, right? So I believe there's $100,000 in debt, so therefore the rate of this debt is 10%. So your pre-tax company or pre-tax income for this company is $40,000, but pre-tax income for this company is going to be $30,000. Okay, so my corporate tax rate is 40%. Okay, so all you do is you just take 40% of your pre-tax income. This company with no debt pays $16,000 in taxes. This company that has debt only pays $12,000 in taxes. Okay, so therefore, when I get to my net income, Company A with no debt has $24,000 in net income, whereas Company B has $18,000 in net income, right? So we're gonna notice here that there is basically a 6K differential, right, between these two. Yet on this one, the difference is 10K, right? And here, we pay 4K less in tax. Okay? So we deduct $10,000 more, but because of that $10,000 deduction, we pay $4,000 less in tax, right? So the net impact on our bottom line is only $6,000, even though we deducted 10, right? So in this case, when we calculate what a return on equity is, you have to remember that this company only has $100,000 in equity versus this company with $200,000 in equity. So the bottom line net income is split across less shareholders in this case. So our return on equity for this company is at $24,000, right? And it's divided by $200,000 in equity, right? Whereas this company is $18,000 in net income attributable to our shareholders, but it's only divided by $100,000 in equity, right? So this company does a 12% return for its shareholders, while this company does an 18% return for its shareholders, right? So what we end up seeing here is that this company actually is better for our shareholders because it does a higher return on their investment. If we also look at, say, which company may be worth more, right? And we'll kind of see this. Do I want to pick this up in this section? Yeah, we can pick it up in this section. So if I want to look at, like, we know that firms are valued at the cash flows that they end up paying out, right, to their investors. Debt holders are just as much investors as shareholders, right? So if we look at the total available to pay out, right, in this case, we have net income, right, which is available to pay out to my shareholders, $24,000 worth of net income, right? But we also have to consider that there's interest, right? That is also paid out to investors. In this case, when we have no debt, there's no interest paid, but in this case, this company has $18,000 in net income that it can pay out to the shareholders, but it also has another $10,000 in interest that it pays out to its debt holders, right? So this company pays out a total of $28,000 in returns, right? Whereas this company only pays out $24,000 in returns. So this is all purely driven by tax, okay? Corporate structure does not matter if there's no tax implications, and I'll show you how that works as well. But very, very high level here, what ends up happening is when you add on debt, right, it increases the return for your shareholders, and then it also increases the total amount of returns that are available to pay out to total investors as well, right? Even though it decreases your bottom line, it increases the return for your shareholders, and then also increases the amount that you can pay out to your equity holders or to your debt holders. So this is basically why when we do add on financial leverage, it ends up being that the firm is worth more. Okay, so why does leverage increase return? Well, more cash flows are available, as I just showed you, 24 versus 28, and taxes paid are lower. Therefore, when we pay less taxes, more available to pay out. Equity is therefore proportionally lower than net income, right? Because we're decreasing equity by, like in this case, we decreased our equity by 100,000. But we only decreased net income by 4,000, right? Or sorry, 6,000, right? So in that case, obviously that really cranks up the return on equity, right? This is the benefit of bringing in debt to our capital structure. Now consider the fact that earnings before interest and tax is not known with certainty, right? So 5 possible states may arise. What is the impact of uncertainty on stockholder profitability and risk, whether or not the firm borrows? So here is unleveraged and you have no debt. So we do this, this is kind of called scenario analysis, right? We're impacted by business risk. This is what is likely to happen in the economy. So under a normal, right, a normal year, we'd expect, this is 50% probability. And this is the circumstance we just addressed with $40,000 in earnings before interest tax. We pay $16,000 in tax. Net income is $24,000, and then our return on equity is 12%. But say in a bad year, right, or a poor year, 20% chance this happens. We have a loss, and basically earnings before interest and tax of negative $20,000, right? Therefore, in this case, we actually get taxed back on that loss, technically, right? So our net income is a loss of $12,000. So what ends up happening in this case is our return on equity is a 6%, like basically decrease, like 6% loss. And in a really bad year, our return on equity would be an 18% loss for the shareholders. A good year, we'd expect about a 30% return for our shareholders. 20% probability of this happening at earnings before interest and tax of $100,000 with a net income of $60,000. Whereas in a phenomenal year, 5% chance of this happening, we'd have $140,000 in earnings before interest and tax. We pay $56,000 in tax. We have $84,000 net income, and we generate a 42% return for our shareholders. What happens when we add debt to the equation? If you remember, right, we had that very, very tight normal distribution for the company that had no debt, and there was a very tight returns. Whereas with the company where we added debt, right, basically the returns, they kind of stretched out, right? So in this case, this is what we see here. Whereas in a terrible year with a company with no debt, it was only 18% loss. In a terrible year with a company with debt, higher leverage, higher risk, they would in that same breath generate a 42% loss for the shareholder, or for return on equity, right? So whereas their baseline, as we calculate here, 18%, right? It's on average higher. So when you add in leverage, on average, your returns are going to be higher, but the spread of your possible outcomes is also much wider as well. So our best year would be a 78% return, right, for our shareholders. A good year would be a 54% return versus if I had no debt, the best I could do is 42%, right, and 30% in a good year. So the distribution of my possible outcomes is much greater when I add in debt. So it's higher risk, higher return, right? That's the impact of financial leverage. So conclusions, basic earning power, EBITDA, divided by total asset, right? And return on invested capital are unaffected by financial leverage. So firms with debt has a higher expected return on equity because of the tax savings, and smaller equity base as well because they're financing with debt, therefore they have less equity. And firms with debt have a much wider return on equity swings. So in good years they have really phenomenal returns, and in bad years they have really bad returns, right? High risk, high reward. So in a standalone risk sense, in a firm with debt, stockholders see much more risk rather than a firm with no debt because the volatility, right? With debt, we see a standard deviation of 29%, almost 30%. With no debt, it's only 15%, right? Coefficient of variation is also much larger as well. The increase their beta, basically. So using leverage has both good and bad effects. High leverage increases expected return on equity, but also increases risk as well. So capital structure theory. Capital structures vary considerably across industries and among firms within a given industry as well. And factors to explain these differences are explored in a number of different theories when we try to explain why capital structure theory exists, right? So here is the model if there was no taxes, no corporate tax, no personal tax, nothing, right? So if there were no taxes, right, we have basically your value L, which is value of a leveraged firm. It would basically be equal to the value of an unleveraged firm, right? Because there are no tax savings, right? So there's no difference between the value of a leveraged firm, a firm that has debt versus a firm that has no debt, right? It's just one firm pays out more interest, whereas the other firm pays less interest and more dividends. They're still paying out total returns that are pretty much identical. In Proposition 2, if there's no taxes, as debt increases, the cost of equity also increases, right? So even if debt was at a lower cost, well, as I issue more debt, my cost of equity is just going to go up. My weighted average cost of capital ends up being the exact same no matter what I do because I'm not getting any benefits from taxes. So let me show you how this would look. So for firm U, pays no interest because it has no debt, right? This is an unleveraged firm. So it's a total of $3,000 to pay out to its shareholders, okay? Whereas firm L, and again, there's no tax effects here, right? Deducts $1,200 in interest, right? So it has $1,800 to pay out to its shareholders, but it also has $1,200 to pay out to its debt holders. So the total cash flows for both firms are both $3,000, right? So that's in the case where we're not receiving this, or paying $4K less in taxes. They are not paying any less taxes for issuing, for having debt in their capital structure. Therefore, it doesn't increase the value of the firm to have debt. The values of the firm are completely identical if we don't have tax. So the result, basically under these assumptions, Miller model, right, proved that if the total cash flow to investors for firm unleveraged and firm leveraged are equal, then the total value of the firms for unleveraged and leveraged would be equal. So because free cash flows and values of firm L and U are equal, their weighted average cost of capitals are also equal as well. So therefore, capital structure is completely irrelevant if we don't have tax. Tax implications of being able to deduct interest. So, and then arbitrage proof, right? Even if there were momentary discrepancies in the market between how shareholders perceive the value of firm L versus firm U, The idea is that the underlying assets are worth the same, and the market would pick up on this. So shareholders would basically take advantage of this, and they would basically buy up the undervalued asset, right? And they would sell off the overvalued asset, right? And then what would happen is the undervalued asset would go up, and if it went too far, they would sell that one off, right? And then they would switch over, and they would make a small profit by basically selling equal commodities. So what ends up happening is the shareholders' valuation of the firms, it would drive them to be equal to the exact same, even if it wasn't perfect on the market. And then homemade leverage. Investors would basically make arbitrage profit by selling shares of higher valued firms to buy those of the lower valued firm. Typically, they need to borrow invest at the risk-free rate. So the process will continue until the two firms have the same equal value. Basically, the market will make sure that the firms end up being the same, right? And then with short sales, it doesn't necessarily have to be that you sell off the higher value asset, right, to basically buy the lower value asset. You can also short sale the high value asset, right, so that when it goes down in value, you make money. But we're not going to go to that level. But arbitrage is one of the most important ideas in modern finance, right? It's that the market drives valuations of firms, and they will pick up on discrepancies. So the Miller model with corporate taxes. Corporate tax laws allow interest to be deducted, which reduces tax paid by levered firms. Therefore, more cash flow goes to investors, as we see here, and to taxes then leveraged when leverage is used. So in other words, the debt shields some of the firm's cash flows from tax. Okay. So, Proposition 1, with taxes, so the model shows that the total cash flow out to the firm, the leveraged firm's investors is equal to total cash flow from the unleveraged investors, right? Plus an additional amount due to interest deductibility, right? So the formula for this is if we have a firm that is unleveraged, and we want to know what that firm would be worth if we added financial leverage, all we would have to do is take the value of the leveraged firm, which is this, the value of the leveraged firm here. And then if we just took that value, right? So if we took the value of the unleveraged firm and then added on the total debt that we want to add on, which is D, multiplied by our corporate tax rate, that would be how much basically we increase the value of the firm by adding on debt, right? So if our corporate tax rate is 40%, then every time we add on $1 in debt, the value of the firm goes up by basically 40 cents is the idea of it. Graphed out, this is what it looks like. So the value of firm L, right? This is the value of the unlevered firm, right? And then, right, as we add on debt, right, the leveraged firm, it becomes worth more and more and more and more because we're taking that total debt that we're adding it and we're multiplying it by the tax rate, right? So inherently speaking, the value of a leveraged firm is always going to be more than the value of an unleveraged firm because we're saving on taxes, right? And therefore, it increases the amount of income we have to pay out, right, to both debt holders and shareholders, which makes the firm worth more because its present value of future cash flows is therefore higher, right? Okay. So let me show you how this works. And basically, I'm going to go ahead of the slides a little bit here, but I'm going to do it in a way that I can walk you through basically the performance of weighted average cost of capital and also how it impacts the valuation of the firm and how it also impacts the cost of equity as well, right? And I'm hoping that me going through it like this will help you. If I slip up on anything, don't hold me to it. Again, I'm not feeling too well today, so cut me a little bit of slack if you can. So, let's work through this together. Where's my marker? There it is. All right. So, this is a firm with no debt, okay? Yeah, a little more space because this one's a little more intensive. And this is a firm with debt, okay? All right, so when we're determining corporate value, okay, this is value, value, right, stands for V for an unleveraged firm. That's what the U stands for, okay? And then this over here is value, but it's value of a leveraged firm. That's what the L stands for, okay? That's how you read this. So, if I have a firm, right, and the VU, this value, the unleveraged value is $20 million. What ends up happening is if I want to know, say, the value of this firm, if I add on debt, what I would do is I would take VU, right? So it would be the value of the unlevered firm plus T times D, right? Which is the tax rate times the amount of debt I want to add. So in this case, say I take that same firm, that has the 20 million of valuation, but I want to go and add on $10 million in debt and my tax rate is 40%. What I would do is I would take the 40% tax rate and I would multiply it by the $10 million in debt I want to add. So the new value of my firm, VL, the leveraged firm, that firm is going to be worth $24 million, right? So basically, if I take the same firm, worth $20 million over here, right? And I just add on $10 million worth of debt at a corporate tax rate of 40%, what's going to end up happening is my firm is going to be worth 24 mil. Okay, so, sorry, my camera's doing some wonky things. All right, now, the value of the equity, and this is where it gets interesting, okay? So, value of equity, okay? In this case, we know that per the fundamental accounting equation, assets equals liabilities plus owner's equity, right? This can be rearranged so that your owner's equity equals your assets minus your liabilities, right? That's what we call basically the total equity value, the residual value of the firm, okay? So in this case, the value of the equity for this firm over here, right, is going to be the $20 million total value, right? So 20M minus the $10 million that, so minus the $10 million in debt, right? So in this case, what you would have is a residual value of 10 mil, right? I just want to draw a line, right? Whereas over here, when we're doing our valuation, and you have, say, 24 mil, sorry, this should be 0, right? And then this should be 20 because there is no debt. Okay, so, and then when I have the valuation over here, right, of my equity, it's going to be the 24 mil minus the $10 million in debt, which I've added, right? And that's going to be a $14 million residual value for my shareholders, okay? So it's not necessarily a perfect split, right? Because my value went up by $4 million, right? But I deducted 10, so therefore the value of my shares are worth 14 million now, right? So the valuation of the equity only went down by $6 billion when I basically added on $10 million worth of debt, and that's because of the tax effect of this 10 million multiplied by 40%. So here's what happens to my cost of equity, okay? and this is also known as RS, okay? So I know that RSL of a leveraged company equals basically the RS U unleveraged, right, plus RSU multiply or subtracting the cost of my debt, right, and then multiplied by D over S, which is my debt level divided by the amount of stock that I have, right? That's what this is. Sorry. So in this example, what we're moving from to is basically, and I have to make a quick adjustment on my end. So we talked about the different valuations, right? I was wondering why this was happening. So we've covered basically how adding on debt impacts the valuation of the firm. Now we're going to look at basically no taxes versus taxes, okay? So in this case, 10, 10, right? And this is going to basically help me show you tax implications. Okay, so it would be 14 mil versus 10, right? So if I had $10 million in debt, no tax implication, my shares would be worth 10 million. If I add in the 40% tax implication, the shares worth 14 million, right? So that was just from the evaluation that we did up there, right? So if I'm trying to do this now, and I'm trying to calculate basically what my cost to equity is, what I'm doing here is 0.12, which is basically my unleveraged cost to equity. And then I just add on the 0.12 minus the cost of my debt, which in the slides is about 8%, so 0.08. And then I multiply it by 10 over 10. So 10 mil in debt, 10 mil in equity, right? So what ends up happening is my new cost of my equity, right, would be 16%, okay? Whereas when I factor in my tax implications over here, what ends up happening is for the exact same formula, what we would do instead is we do basically RS of a leveraged firm, the cost of a leveraged firm, equals, so 12% like we did over there, but we go plus 12% minus 8%, times 1 minus the tax rate. Yep, so 1 minus tax rate, so 1 minus 40%. And then multiplied by the capital structure, and in this case the capital structure is 10 over 14, right? Because the two key differences between this situation and this situation where I have no tax versus tax is my equity is worth $4 million more, which I reflect right here, and I'm factoring in that my interest is tax deductible as well. So in this case, what happens is my required return for my shareholders when I factor in taxes ends up being 13.71%, okay? So by factoring in tax, right, my cost to equity actually drops from 16 to 13.71, okay? And by factoring in tax, the value of my equity goes up from $10 million to $14 million, right, for the same amount of debt, okay? And when I do my weighted average cost of capital, it ends up being, so in this case, right, both cases are, well, no, not quite, we're not 50-50 split. In this case, it's a 50-50 split, 10 million versus 10 million. So 50%, that is the weight of my equity, multiplied by, in this case, sorry, that's the weight of my debt, 8%, which is the cost of my debt, right, plus 50% times the cost of my equity, right, as I calculated here at 16%, right? So then my weighted average cost of capital, funny enough, comes out to 12%, right? So before, when I was 100% equity financed, right? My weighted average cost of capital was 12% because that was the cost of my equity, right? And then say I added on $10 million in debt, but I had no benefit of taxes. My weighted average cost of capital is still 12%, right? Because sure, I added on debt, which was a lower cost, but my cost of equity went up to 16% from 12% proportionally, right? So my weighted average cost of capital stays the same when there's no tax. Stays the same, right? I heard a hand go up. I'll finish off this calculation and then I'll take your questions. So then under this case, right, if I do my weighted average cost of capital, but I factor in tax implication, what ends up happening is I get, basically I have to do my new weighting, so it's gonna be 10/24 for my debt, because my valuation of my firm is 24 million, not 20 million as it is over here. And then I multiply that by the 8%, okay? And 8% is basically the cost of my debt, but then I do 1 minus the tax rate, 1 minus 40%, because this is tax deductible, right? And then I add on basically the 14 million, which is my equity valuation, divided by the total valuation of the firm of 24 million, and then I multiply that by the cost of my debt at 13.71%. Okay? And then when I do that, my weighted average cost of capital comes out to a nice even 10%. So, high level summary, okay? Because I know, right, we did a lot of calculations there, but this is what I want to point out to you. I wish I had a different color marker. Maybe I do. But this is what I want to point out to you, and then we'll chat about any questions that you might have. By bringing in tax, okay, tax reduces my weighted average cost of capital, okay, went from 12% to 10%, and it also reduces, right, my cost of equity because I get tax back, right, which increases the amount I have available to pay out to my shareholders, and then therefore, reduces the risk of my shareholders, right? So my equity costs less, my weighted average cost of capital also costs less, and then additionally, the effect of taxes is they increase the value of my firm when I bring on debt, versus this would not happen if it wasn't for corporate tax, okay? All right. Yes, question. Go ahead.
Hi, Ryan. I'm just kind of a little confused between the cost of equity, like you mentioned. It's
Yep.
gonna go to 13.7, but over there the value has increased. So I'm just kind of a little confused. How is that happening? Like the cost has gone down, but the
Yes.
value. So value means that we're gonna like provide this much amount to the equity, right, shareholders, right? So we are giving them more comparatively. So our cost should rise. Like I'm thinking like that way.
Yeah, so in this case, right,
Yeah.
this is the situation of basically no tax versus taxes, right? So what happens is in both cases, we would have $10 million in debt, right? But by the tax implications, it brings down my cost of equity because there's more net income to pay out to shareholders, right? Because I get taxed back, right? And therefore that reduces my shareholders' risk. Now, if I'm hearing you correctly, in the sense that if I had zero debt, right, versus having debt, right, when I introduce debt, it does bring up my cost of equity, right, because it increases the risk to my shareholders, right? So my point in this example, Kieran, I'm sorry, the split between, I remembered this in my last lecture, but then I forgot it in this one. The split was a little confusing between where I went from valuation of no debt versus debt to now the impact of tax versus no tax. I didn't mean to do that, but I needed to do that calculation to show you the difference in, say, values, right? But basically, in this full example here, right, basically just the simple act of getting tax back which increases my net income, will therefore end up reducing my cost of equity. Whereas if there was no debt period, my cost of equity would be lower because very high level, the risk to my shareholders would be lower, right? But as I bring on debt, risk increases, and as I showed you in the other example, return on equity also increases as well to basically compensate for that risk. Does that make sense? Kind of?
Yeah, it does. I think I'm still confused between the thing that you already mentioned, that was the debt, and the. But yeah, okay. Yeah.
Okay, cool. Yeah, so the first thing that I went through, right, it was purely, this is if a firm has zero debt versus this is a firm has debt, and then that's how it increases the value of the firm, right? But that increase in value of firm, you have to remember, that's because of tax, right? So how that carries through is in this case, right, if there was no tax, that previous example that I did means nothing, right? Because the firm would be worth exactly the same at 20 million, versus if there is tax, right? It's the argument of the value of a levered firm equals the value of an unlevered firm multiplied, or sorry, well, yeah, plus T times D, right? Which is your tax rate and then total debt brought on, right? So the difference in valuations of the firm, to tie the previous example into this, right? We brought on $10 million in debt, multiplied by 48%. So therefore, because of tax, right, and this is the point I should have made, because of tax, this firm's worth more, right, $4 million more, and therefore equity is worth $4 million more because the debt level is the exact same, whereas this firm is worth $4 million less. Because there is no tax benefit, basically. I hope that kind of reduces the confusion. That's totally on me. I didn't transition between my examples very effectively.
No, I got it now. Yeah, it's
Okay,
clear.
excellent. All right, thanks. I'll next year I'm gonna have to redo this recording so that screw up isn't there. But thank you for helping me clarify that for the rest of the class. Okay, we'll continue on. So, yes, I'm presenting. Proposition 2, with corporate taxes, right? So the cost of equity to a levered firm is equal basically to the cost of equity of an identical unlevered firm plus T times D, right? Tax rate multiplied by debt. And the risk premium depending on the difference between the cost of equity and the debt and the financial leverage as well as the corporate tax rate. So this is the equation that basically I just did to convert what my to convert my unleveraged cost of equity into my leveraged cost of equity. To do this, I basically have to know what the return on the debt is, right? And that is RD, that's my cost, right? I need to know the tax implication and I need to know the leverage, right? What proportion debt am I bringing in? Those three variables allow me to convert my unleveraged cost of equity into my leveraged cost of equity, right? And they drive that change. So corporate taxes cause the cost of equity to rise less rapidly with leverage than in the absence of taxes as well. So here's what happens. Basically your RD, and this is in theory, this is purely in theory, okay? So under this model, so RD would basically stay the same as you move from 0% to 100% debt financing, whereas as you shift over, your cost of your shares, right, your leverage cost of equity really increases, right? Because as I move and I finance more and more and more and more with debt, what ends up happening is the cost to my shareholders, right? Because of that risk, they require a higher and higher and higher and higher and higher return to compensate them for that risk. What actually ends up happening in real life, and I'll show you at the end of this, is yes, my required return my shareholders goes up, but my required return from my debt holders also goes up as well, because right, as they grant me more debt, there's more of a chance that I don't pay them back, right? And therefore, it's like when you go to a bank, right, and you already have a couple $100 million in debt, and you're like, oh, I want a couple $100 million more. Well, are you even able to pay that, right? So instead of maybe a 6% rate, now they give me a 12% rate, right? Because I'm a higher risk client. It also impacts my credit rating, which impacts my ability to acquire debt. So levered and unlevered beta. So the model or the theory implies that beta changes with leverage, which is true. So if we just do a quick refresher, beta is my company's basically correlation to the market, right? So the S&P 500, right? Say the S&P 500, which is just the very general stock exchange, goes up by 2%. That's the average performance of every firm. If I have a perfect one-to-one beta, my firm's also going to go up by 2%, okay? If my beta is 2, the average goes up by 2%, I go up by 4%, right? If my beta is 0.5, right, the market goes up by 2, I only go up by 1%, right? So it's my correlation with the market returns, generally speaking, okay? When I add leverage, and as I showed, right, the volatility of my returns increases, right, as I add in financial leverage. Therefore, my beta actually also increases as well because it makes my returns far more volatile, okay? So the beta of a levered firm is basically levered beta, right, BL, and it's calculated by taking the unlevered beta and we multiply it by 1 plus 1 minus the tax rate multiplied by debt divided by my equity balances, okay? And this is basically factoring in the impacts of taxes as well as factoring in my capital structure to determine how much that actually impacts my unlevered beta to get to my levered beta, okay? If I wanted to go the other way and I had my levered beta number, I can work backwards and just go my levered beta divided by 1 plus 1 minus the tax rate multiplied by my debt levels, right? As I did here, like D over S, like say 10 over 24. And that would take me from my levered beta to my unlevered beta, okay? So basically, how volatile would my firm be if I had no debt, right? Versus I have debt, or versus say I had or no debt, and I want to know how volatile it would be if I added on $40 million in debt. I could calculate my beta by adding on, say, 40 million, 30 million, 20 million, okay? I'm gonna release a question to you. It's a very good question. And it basically takes you through the difference in capital structure between 6 million, 18 million, and $30 million of debt, okay? And it shows you how your beta changes and how your cost of equity would change by adding on that debt. And it really ties in this calculation with other calculations I'm showing you as well, okay? Yeah, go ahead.
I just have one question. So beta is the market risk, right? Like how it. So how does the leverage, like adding more debt, is gonna affect the market risk of the company? Like,
Well, it doesn't kind of. It's beta is it's the correlation to the market, okay? So if the market goes up by 2% and my beta is 2, I go up by 4%, right? So it's how correlated I am to the market, right? And basically what I can expect from a company based on how the market performs. So if I own a stock that has a beta of 3 and I see that the market returned about 2.5% on average, that stock with a beta of 3 will return 7.5, right? 2.5, 5, 7.5. It'll return 3 times, right? So it is a measure of the risk, right? Because when we define market risk, we define market risk as volatility, right? So as we get over 40 stocks, we are no longer really worried about business risk anymore. We've diversified to the point that that's not really a concern, right? So at that point, what we define risk as is the basically the probability that we don't achieve our required return, right? And that probability can be defined as how broad are potential outcomes. When you have a company with a very high beta, they have a very wide potential for outcomes, right? Because when the market goes up by a little bit, they go up by a lot. But when the market goes down by a little bit, they go down by a lot, right? So in that sense, when I introduce debt, right, and as I showed you, by introducing debt, my return on equity went up to 18%, right? Whereas the baseline was only 12 with no debt, right? And I also showed that as in my really good years, I would achieve a 72% return, whereas with no debt, I would only do 40, right? Whereas in a bad year, I would maximum do like something around 30% loss, whereas if I had debt, it would be like 50% loss, right? So that is basically high level from a theory basis that by introducing debt it basically makes my return on equity far more volatile, right? And therefore also makes my stock more volatile as well when compared to the market, because the market doesn't change, right? It's just how much do I move relative to that market, okay? And that's why this formula is valid. Does that make sense in a very roundabout way?
Yes.
Yes, excellent, okay. You're testing my knowledge here, I like it. It's a nice change from me talking to a screen, I appreciate it. Okay, so every time I click this. So illustration of the MM model. Frederickson Wire Company currently has no debt, and expected earnings before interest and tax is $2.4 million, and with no growth. All income is paid out as dividends. If Fredericks begins tomorrow, the required return for their debt holders is 8%, held constant. Debt issued to buy back common stock, and there's basically no assets remain constant, right? So assets remain constant, sorry. And unlevered beta is going to be 0.8, right? So with everything factored in, they give me the risk-free rate. Anytime you see a risk-free rate, you see a market rate of return, like a market risk premium. And you should basically be immediately thinking, okay, I also have beta, I have everything I need for the Kaplan equation, right? Risk-free rate plus market risk premium times beta. So I can calculate the required return of the stock, okay? So that's exactly what I do here. My unlevered required return for my shareholders, right? RS stands for required return for shareholders. U stands for unlevered, is equal to that 8% risk-free rate plus the 5% market premium multiplied by my unlevered beta, right? If I had my levered beta, I could calculate my required return for a levered, basically a levered stock, right? So, but this is specifically unlevered, so I use my unlevered beta to calculate my unlevered return, okay? So, this is the exact example that we just did here. So you're gonna notice that all the numbers line up, okay? So, high level, right? The firm is going to be worth $20 million, right? I believe this is the same one, right? And then basically I'm going to do the 20 million minus the $10 million in debt. So therefore, my equity is worth $10 million. And then when I do the calculation of the required return for my shareholders, the required return goes up, right? From my unlevered, right? So my unlevered required return was 12%. My levered required return is 16%. So by adding on debt, my shareholders require 4% more return to compensate them for that risk, right? And this is the ignoring the impacts of tax, whereas my weighted average cost of capital basically stays the exact same. And then when I do factor in corporate taxes, right, what ends up happening is my firm's worth $4 million more, right? Because the $10 million in debt plus 40% tax rate, that's a $4 million boost to the valuation of my company. So the firm's worth 24 million, the debt's worth the exact same 10 million. So therefore that valuation boost goes directly to my shareholders, and my shareholders are now worth 14 million instead of just 10, right? And then therefore when I factor in the tax implication now, the tax implication reduces the risk, right? Because there's more net income to pay out to the shareholders, right? Because I get a tax deduction, and therefore this drops my required return to my shareholders, which in turn, because now my required return to my shareholders is lower, right? And I'm also factoring in that I get a tax break on my debt as well. It also significantly drops my weighted average cost of capital from 16% over here to when I do factor in the taxes, it drops down to 10%, right? We can kind of do this very quickly now because we did it more detailed up there. But if you are looking to recreate what I did on the board, it's all here by all means, okay? And then applying capital asset pricing model, the levered cost of equity, right? So levered would be 8%. Risk-free rate doesn't change, right? Because that's market. Just because me adding debt doesn't impact the external market, right? Just like me adding on debt doesn't even impact the market risk premium. That's for the whole market, right? I'm just this little fish and we're in the ocean here, okay? Those two stay the same, but my beta does change, right? Because that's me and that's my correlation to the market. So when I calculate my levered beta, I take my unlevered beta of 0.8 and then I factor in what my corporate tax rate is, right? And then I also factor in that I have $10 million in debt and $14 million in equity, right? Because of the tax benefit, okay? So In a company where the unlevered beta is 0.8, the levered beta becomes 1.1429, right? Becomes more volatile relative to the market because I added on more debt, right? And because now my return on equity is more volatile, right? So in this case, if I take this, right, this 1.1429, right, my new beta, and I plug it into the capital asset pricing model, funny enough, of course, you get the 13.71% required return from my leveraged shareholders, which perfectly matches what I did over here, okay? Which is RSL in my calculation from converting my unleveraged cost to equity to my leveraged cost to equity. It all ties in, right? If I go one way and I convert my beta and then I redo the CAPM equation, I'll get the same answer as if I use this equation instead to do the conversion of my required return for my shareholders, okay? So this is the exact same under Proposition 2 and it proves itself. So the effect of corporate and personal taxes lessen the advantage of corporate debt, right? And this is going even a step beyond because now we're stepping outside of the company and we're looking at the individual preferences of our shareholders, right? There is danger in this because it assumes that all shareholder preferences are the same, which is not the case, right? Based on your capital structure and whether you pay dividends or whether you pay or whether you don't pay dividends and shareholders are in capital gains, right? Because there's only two ways you can make money on a stock, generally speaking, capital gains or dividends, right? You'll attract a certain type of investor generally because of how you've structured your operations, right? So that's where this gets a little tricky is, you know, we're saying here that personal taxes favor equity financing since no gain is reported until the stock is sold, right? And long-term gains are taxed at a lower rate, right? So in this case, we're basically saying that shareholders that they would prefer equity over debt, even though debt drives company value, right? But in a lot of the cases, we don't actually pay attention to necessarily what shareholders want. We do what maximizes the value of the firm, and we'll attract a specific type of shareholder that's attracted to that valuation, right? Because at the end of the day, the whole point, like our job when we're working in finance in a firm, is to maximize the value of the shareholders, right? So yes, we're going to talk about how personal taxes may impact, right? But at the same time, this isn't an area we're going to focus on. So we'll address it, but we're not going to focus on it, okay? Because there's a lot of contrasting views as to why this is not even important either, okay? It's purely theory, but we're just going to bat it around for fun. So the following assumptions are incorrect, right? You know, personal and corporate leverage are perfect substitutes. They're not, right? We know that there are certain combinations of corporate tax and personal tax that don't equal the effective tax rate. Sometimes some things are slightly more expensive, right? Homemade leverage is risk-free. This is the arbitrage proof, right? That's not true. There's commissions, right? It's not free to go from one stock to the other, right? Brokerage costs are assumed away, not correct. Debt can be taken at the risk-free rate, also not correct. You know, debt fluctuates based on term. There is no cost associated with financial distress, which is also not correct. The more debt you have, the more costly that gets. You also have to start dealing with bankruptcy costs, right? So these are all the criticisms that come with all this theory we've talked about. We're going to look at what more realistic theory looks like. Putting away the pure textbook and looking at what actual you know, application to the real world would be. So beyond the models, the unrealistic assumptions provided a place for subsequent research to the extent, right? So these models, I believe they were developed, don't quote me on this, but I believe the study was published sometime in the 60s. I think it was around 68 or 66. These paved the way, right? This was like, think of this as, I don't know, Isaac Newton when he, you know, came up with the theory of gravity, right? And, you know, the apple fell on his head or something and he started doing calculations, right? Think of it like that, okay? Everything that we've covered is like basically Isaac Newton level, where we've talked about the theories of all capital structure, okay? But these theories, they have a lot of assumptions because at the time, they had to make assumptions so that they could make this work, right? Whereas now in the real world, we know that there's different theories for different circumstances. There isn't one theory that applies to all, okay? So we're going to look at what the more modern theories are that built on top of this, okay, and when they're applicable. So we're going to start off with trade-off theory. Theory ignores bankruptcy, right? Financial distress costs. As you become more and more and more costly, there are financial distress costs because you become more risky, right? And therefore your debt cost becomes more and more, right? Whereas this was completely ignored in the models. The models show that as we went from 0% debt financing to 100% debt financing, basically the cost of debt remained exactly the same. This isn't true in real life. In real life, it goes up, okay? So at low leverage levels, tax benefits outweigh the bankruptcy costs, which is true, right? There's a point where you keep taking on debt and it's dropping your weighted average cost of capital because you're taking advantage of that tax rate and you're driving up the value of your firm, right? Because T multiplied by D, you give a boost to the valuation of the firm, right? And the MML will assume that this just continues on. It doesn't. Because there's a point where your bankruptcy costs start kicking in, you start becoming high risk, and everything starts getting really expensive, from your cost of debt to your cost of equity to everything. And it's no longer beneficial to the firm because your cost of financing the firm is so damn expensive, right? So at high levels, bankruptcy costs will outweigh tax benefits, absolutely. And an optimal capital structure exists that balance these costs and benefits. There's a great little a graph at the end that shows you exactly how this works. So here's how real life works versus the theories. This is the theory, right? So value of debt, this is the value added by the debt tax benefit, right? So D times T. So, and this is as we add on leverage. So under this theory, it assumes that the firm value just continues on forever increasing as we add on debt. And then the theory also theorizes that the value of firm, if they use no financial leverage, right, would remain exactly the same, right? Whereas the reality is that, yes, this is most likely true when it comes to not doing zero debt, but the red line is not true. What actually happens is the value of firm starts to really tank as we just start taking on too much debt, because our cost of debt and cost of equity go through the roof, right? And therefore our firm's not worth much anymore because it's so high risk. We can't even trust that cash flows in the next 10 years. We can't trust their existence, right? We have to use a weighted average cost of capital like 50%. That massive discount rate reduces those free cash flows so much, right, that the firm's essentially worth so much less. It's almost worth nothing because it's such high risk, right? That's what drives down the value of the firm. So we also have signaling theory, okay? And assume that investors and managers have the same information, but managers often have better information. Therefore, if they sell stock onto the open market, me as an investor, if I see someone with insider information selling stock in the open market, I'm going to assume that they know something that I don't, and they believe that the stock is overvalued, right? They're trying to sell when it's at a premium, right? Whereas if I see that management is selling bonds, I'm going to make the inherent assumption that they don't want to sell stock because they believe their stock's undervalued, right? Why would they sell low right now? So instead they'll issue debt. So to me, the issuance of debt is a trigger to buy equity, because that issuance of debt, as I showed up here, it's going to boost the value of the firm, right? And therefore, if I jump in and buy equity, I'm also assuming that management thinks that my equity is undervalued. It's going to go up in the future. These are the psychological signals that get sent to the market. The market is not perfect, okay? A lot of the times, you're going to have situations where your shareholders are going to basically try to read management's actions, right? And a lot of times, and as we'll see in chapter 13, they get it wrong, right? Not all the time does issuing equity necessarily mean that management thinks that, stock is basically undervalued. Cutting dividends does not always mean that the firm is at risk. It might actually mean they have a lot of opportunity on the table, right? So signaling theory is very real. And sometimes you'll see like a firm cuts its dividends by even 10% and the valuation cuts in half on the stock market, right? It's all investor perception. It's all investors reading in to management's actions, because investors know that management knows better than them. They have all the insider information and they try to read their actions, right? To basically time the market and time their investments. But management has to know this. So management has to think, okay, the investors don't know why I'm doing this, right? So they're going to read into why I'm doing this, and I have to understand how that's going to impact my stock price. How is this going to look, right? And understand how my investors are going to react to my actions, because they don't know the whole truth, right? So investors understand this, so they view new stock sales as a negative signal, and basically the stock price tanks because they sell off. What are the implications to managers? A debt offering is taken as a positive signal. So if I issue debt, I can expect that my stock price is actually going to go up. It's quite fascinating once you get into the actual psychology behind it, honestly. Finance can be fun, believe it or not. So issuing stock emits a negative signal and thus tends to depress the stock price. And then in normal times, the company should maintain a reserve borrowing capacity to be used for some especially good investment opportunity. That way you don't have to issue debt, right? You don't want to be, or sorry, you don't have to issue equity. So you don't want to be in a situation where you have a great opportunity and all of a sudden you have to issue equity, right? Because if you do that, yes, you will get the financing to do it, but your stock price is going to take a hit in the process, right? Which sucks. And firms should use more equity and less debt than is suggested by the trade-off model as well. Just because equity is lower risk than debt. Even though we have gone through, yes, debt boosts the firm value. Yes, we get a tax benefit from the interest on debt, but we can't ignore that when you get into hot water, you have to pay your interest, and that can push you into bankruptcy, right? So theoretically, despite these theories, it is still better for longevity of a firm to have slightly more equity than debt, to be honest with you, because it leaves a little buffer there if they want to take on more debt, right? But you'd never want to start going too far because it'll catch up with you. Debt gets away from you. So the investment opportunity set and reserve borrowing capacity. Firms with many profitable investment opportunities should maintain their ability to invest by using really low levels of debt and consistent while maintaining a reserve borrowing capacity, right? So by basically keeping, say, my debt low at, say, like 20%, 80% equity, when I have really good opportunities, I can very easily go and get debt financing, right? Without really, taking a hit. Because when I go and I get debt financing, all it's going to do is it's going to boost the value of my firm. My shareholders will take it as a positive thing, right? I would not be going out and getting debt if I was not confident in my future cash flows, right? The only reason I'm going out and getting debt is because I'm confident that I'm going to be able to pay that interest. I'm confident in the valuation of the firm, right? And firms with few profitable investment opportunities should use higher levels of debt, right? Because I don't have much to invest in, right? I'm not going to need a whole bunch of reserve borrowing capacity. So I might as well just crank up my debt now, get all that tax benefit, absolutely maximize the value of firm for my shareholders, and just kind of hold it at that level because it makes a lot more sense, right? Whereas a firm that is going to have to make investments should keep a low level of debt so that they have the excess capacity to make the investments when they need it, okay? And then we have pecking order hypothesis. So firms use internally generated funds first because there is no flotation costs and no negative signals, right? So to issue debt, I believe like under 100 million, you're paying like 15% to your underwriters, right? So say you issue $100 million in debt, you have to pay out 15% of those proceeds, right? So you only get $85 million, right? The other 15 million goes to whatever agency or clearinghouse that's basically underwriting the shares for you. This gets lesser and lesser the more equity you issue, but still. You have to consider that there are flotation costs when it comes to issuing bonds, when it comes to issuing shares, right? So if more funds are needed, firms then issue debt because it has lower flotation costs, right, and equity than equity, and it has no negative signals. If even more funds are needed than what's internally generated and what can be provided by debt, then firms issue equity, right, because they absolutely need it. They take the higher flotation costs and they take the hit to their stock price. Because they think the investment opportunity is worth it. So this is how it works, right? If you're generating internal cash flows, there's no negative signal of using internally generated cash. No one cares, right? It's the cheapest form. Now, I can use the $100 million in cash, but say I need 300 million, I can't use my entire 100 million in cash. Now I need some external financing, right? My next I'm going to go to is debt. It has a lower flotation cost. It's cheaper to issue, right? It's not going to create a hit to my stock price because my investors will actually take it as a positive signal, and it's cheaper than equity because I get the tax deduction, right? So next, I'll move from internally generated funds to using debt to finance my projects. But if last resort, I can't get enough debt or it'd make me too risky, then I move on to equity, right? I'll take the higher hit to the flotation costs. I'll take the hit to my share price, right? Because in the end, I believe it's gonna be worth it and it will drive the value of my firm. I don't know if anyone remembers this, but a year and a half ago, Meta, like Facebook, right? It was not doing well. I was a shareholder with Meta at the time, and it was down, right? Like investor perception was really bad, and they were taking a lot of signals from the market that and this was right after the whole what was it? Zuckerberg's like virtual world, basically, right? That he's trying to sell. He was trying to sell like you can buy a house next to Snoop Dogg in this like virtual world. Investor perception was terrible. Look at Meta now, right? Yes, they took a hit, but they've really taken off, right? So sometimes, yes, investors will make they'll have a perception of a firm, and it's not always accurate because in the long run, Facebook's profitability ended up being very, very, very strong, right? Because they did end up coming out with, say, the Meta Quest 2, right? And they bought Oculus, right? And they ended up, in the end, actually breaking into the virtual reality market very, very strongly, right? But in the early stages, investors took everything that they were doing and everything that they were trying to do as actually a negative signal, right? So sometimes what you'll see is you'll see a dip, right? But then it ends up turning, it does end up correcting, right? Same thing ends up usually happening with equity issuances. If a firm does issue equity because they're going to finance projects that have a really good return in the future, it will take a hit, but when those projects make a return, the stock will catch up and then go past as well, as we usually see on the stock market. So using debt financing to constrain managers. So one agency problem is that managers can use corporate funds for non-value maximizing purposes. Hey, I'm going to go to this conference in LA, right? Or I'm going to go and go to this technology symposium in Saudi. Nothing against any countries, right? But these are just popular destinations usually for conferences because it's pretty convenient that you get to go to a nice location at the same time as you learn, right? And you just have to go there because that's where the conference is, right? So when you impose debt, it increases the risk of the firm. It confines your financial assets as well, right? So it's not like management has $100 million in cash kicking around anymore, right? They have interest payments to make. So it changes. They're tighter with funds. They're not as frivolous, right? They're not gonna go on a non-value. Okay, when you go on a conference, it does help with value because you're getting knowledge, but at the same time, does it really need to be in LA? You can't just read the book. You can't just do it remotely. Like, let's be honest here, right? So anyways, it reduces non-value maximizing activities, right? And it forces the company to really focus on what truly is going to maximize the value, right? As opposed to maybe doing things that are kind of fun and kind of like perks, but don't necessarily maximize value. And then the use of financial leverage. So it binds free cash flows as well and forces discipline on manager to avoid perks and non-value adding acquisitions. So debt used to constrain managers, a second agency problem is the potential for underinvestment. Debt increases the risk of financial distress, right? So therefore managers may avoid risky projects because, if they have like a super low weighted average cost of capital, right? Like they might just kind of invest in anything, right? But as your risk goes up and your required return also goes up, right? What's going to happen is your weighted average cost of capital goes up, and therefore your threshold goes up too for what kind of projects you're going to accept, right? Managers are going to be really careful, right? And if they have super risky projects, they're probably going to crank up the discount rate like way high to account for that, right? Because they know if they they take $40-50 million in debt and this project falls through, that's a big problem, right? Because now they're constrained by debt. It's not like they just have $100 million kicking around, right? So they're going to be a lot more careful with risky investments as well when you introduce debt. It has a whole bunch of impacts on how the firm behaves in a lot of the good ways as well. And then we have the market timing theory. Managers try to time the market when issuing securities, and this is very true to a T. So they issue equity when the market is high after a big stock price run up, right? So, right now, like NVIDIA is just flying. That's a semiconductor, okay? And basically, this is the perfect time to issue equity, right? Because even if their share price takes a hit, who cares? They're selling at such a premium right now, they're going to maximize the value of their issuance, right? If it takes a hit, it's still going to go up with the amount of backing that they have right now, especially with the shortage of semiconductors and the amount of research and plus AI. It's all powered by semiconductors, believe me. So they issue equity when their market price of their equity is up, right? And then they issue debt when their stock price is low, right? This is exactly what shareholders read anyways, right? But this is market timing theory, and this is what shareholders are reading into. It's just their side of it. So when they issue short-term debt, when the term structure is upward sloping, and long-term debt when it's relatively flat. So capital structure, evidence and implications. Each of the theories covered in this chapter has some evidence behind it. This provides useful insights and guidelines for managers for making capital structure decisions, but different theories tend to apply to different circumstances in different companies, okay? So empirical evidence, the trade-off between tax benefit and bankruptcy costs. So tax benefits are important. $1 in debt adds about, say, 20 cents in value to the firm. That's about corporate tax rate, about 26%. Corporate tax rate in Ontario is about 26.5%, honestly. And the net benefits of debt increase slowly until they reach an optimal level. And then they start to decline rapidly because your bankruptcy costs take off, and then your cost of debt also takes off, right? So the valuation benefit only goes so far. And more profitable firms and more asset-intensive firms have higher levels of debt and support the trade-off model. So now we have dynamic trade-off theory. Stock prices are volatile, frequently causing a firm's actual market-based debt ratio to deviate from its target, right? So we may set we want to be financed 40% debt, 40% equity, 20% common shares, right? For a total of 100% of my cost structure of my firm, right? But this is going to change, right? Because we know those weightings are based on market values. So based on NVIDIA's valuation right now, their stock prices are all-time high. That is really increasing their weighting towards equity financing, right? Because the weighted average cost of capital is based on fair market value. Because of the valuation of the stock market, right? Because it's so volatile, your true target capital structure, it's just a baseline. Your actual capital structure is going to be all over the place because prime rates are changing on your bonds, right? Which deviates, right? It impacts the actual value of your bonds, right? Same thing with the valuation of your stocks is changing, right? Which impacts the weight that goes onto your stocks, right? And the value of your preferred shares change as well, right? So these deviations are going to happen all the time. It's going to deviate from your capital structure more than sometimes you'd like to admit. So however, such deviations don't cause firms to immediately return, right? Our stocks are on a run. We're not going to go issue a whole bunch of debt, right? Just to get our capital structure back to where it was, just for the purpose of just maintaining our capital structure, right? No. Let them run. It's a good thing, right? Don't mess with a good thing. So firms don't always say, oh, my target was 50% equity, I'm up to 60% equity financing, I need to buy back shares or I need to issue more debt to stabilize it back down. No. It depends, right? It depends on what the market's doing. It depends on the shareholder's perception, right? If we're on a good run, we'll just let it go. And then, right, when things start to settle down, okay, sure, maybe we'll buy back shares now to help, manage the stock price, right? Or maybe we'll issue more debt, right? Because now we have projects coming down, our equity is also super high. So let's issue some debt, right? And it's going to help us bring back our capital structure. But just because we have deviations throughout the year, we don't automatically jump to maintain the capital structure. Sometimes we just let the market do what it does and we just wait, right? And see what happens. So market timing, after big stock price run-ups, debt ratios fall, right? But firms tend to issue equity instead of debt, right? This doesn't make sense with the trade-off model. It doesn't make sense with the pecking order either, right? With the pecking order, you should use cash first, debt second, equity third, right? But no, this is consistent with the market timing theory, right? Because we're timing the market because our equity is super high price, so let's get a premium for it, right? So it's interesting how where one theory is perfectly consistent, makes sense, the other two are completely disproven in that circumstance, right? So it goes to show that when your stock's on a big run, you're probably going to apply market timing theory, right? Whereas you're probably not going to use the trade-off model and you're probably not going to use the pecking order, right? Firms tend to issue debt when stock prices and interest rates are low, suggesting that managers try to time the market. Signaling and pecking order. Firms issue equity much less frequently than debt, seeming to support the signaling hypothesis and the pecking order, right? Yet, high growth, high profitable firms issue more equity than debt consistently, right? Just simply because, right, they need as much financing as they can get. When you look at any really high growth firm, they are financing through equity, usually really aggressively, right? Because they don't have to pay dividends. They have to pay interest if they take on debt, right? But if they're still in a high growth phase and they don't necessarily have the cash flows and they need to aggressively reinvest their net income, they don't want to be burning net income on interest, right? They'd rather have the option to take on debt or take on equity, and then not pay any dividends on that equity, retain all of that net income and reinvest that net income, right? So you would assume like this technically, right, goes with the pecking order because I'm actually issuing equity, right, to make sure I have a whole bunch of cash within the firm. So I'm prioritizing the issuance of equity so that I have enough cash to avoid the issuance of debt, right? This doesn't actually line up with the pecking order, but it does. It's confusing, right? And firms have large increases in earnings earnings unanticipated by the market tend to issue debt, which is inconsistent with the signaling hypothesis, right? So all of a sudden, right, my stock looks great and it takes off. Oh, well, my stock's already doing good. I need to stabilize my capital structure. Let's issue some debt, right? Well, it's also going to boost the valuation of my firm, right? That doesn't make sense for signaling, right? For market timing, right? Because if my stock price is high, technically I should be selling equity, not issuing debt, right? So these all mix in. Here's the high level thing, right? It's relative to the situation. It makes sense. You have to evaluate the factors. You can use these different theories. You can use the baseline Newton's law, which is basically the models, which paved the way for all of these, subsequent theories based on research, right? But at some point, depending on your circumstance, you're either going to time the market, you're either going to use pecking order, or you're either going to use dynamic trade-off depending on your situation. And your situation may change, and you may change the theory that you apply to maximize the value of your firm and take advantage, right? So many firms, especially those with growth options and asymmetric information problems, have less debt than might be expected, and many have large amounts of short-term investments, right? So now I have excess cash, I'm not going to pay it out in dividends. I'm just going to invest it into short-term investments, right? And I'm going to earn a return on those short-term investments. They're going to help me finance. This doesn't make sense for anything, right? But firms still do it all the time, right? And it's consistent with the hypothesis that investment opportunities influence attempts to maintain reserve borrowing capacity, right? It's also consistent with tax considerations, but it's not consistent with the pecking order hypothesis, right? Because say a firm takes its excess cash, it can earn 6-8% in short-term investments. It invests all those in short-term investments, right? But then it takes on debt and only pays about 4 or 5% after tax on that debt, right? They're actually still generating value because they're financing their capital projects with debt. They're taking their excess cash flow, investing it on the short-term market in, say, whatever marketable securities or on the commercial paper market, right? And they're earning a better return than they're paying in debt, right? So they're actually generating basically a 2% increase in valuation on the firm, right, by issuing debt and reinvesting their excess cash into short-term investments. Doesn't make sense when it comes to the hypothesis of a pecking order. Pecking order, I should be using my cash and not issuing debt, right? But the returns on the market are so good, I'm investing it instead, right? So it depends. You have to look at what maximizes the value of your firm, and you have to make a call, right? There is no theory that's going to perfectly help you, but they are guidelines, right? Empirical tests. Firms try to capture debt's tax benefits while avoiding financial distress costs. So however, firms also allow their debt ratios to deviate from the static optimal ratio implied by the trade-off theory, right? As we showed with the weighted average cost, with the structure, it may vary depending on the fair market value, right? So there's little evidence that firms follow a pecking order and use security issuances as signals, but there is some evidence to support the market timing theory. So what this is saying is it's really hard to go into the market and say, this firm specifically is definitely using pecking order, right? Or this firm specifically, they're reading into how shareholders would, perceive this, and therefore what they're doing is they're issuing shares because of this, right? It's very hard to say, what firms are doing and why they're doing it, right? But there is evidence to show that firms do time the market. Especially, after a large stock run up and then all of a sudden issue equity, that perfectly supports market timing, right? So I would say of all of them, the most applicable is the market timing theory because it's the most widely recognizable in the market, while the other two are super hard to prove. So implications for managers, take advantage of the interest tax shield by issuing debt, especially if the firm has a high tax rate, stable sales, and less operating leverage, right? Here's just a bunch of long-term debt to equity ratios, right? So basically, how much more debt do I have than my equity, right? So in communication services, these are mature industries like Rogers and Telus Corp, right? Not a lot of people know this, but they're all using the same mobile network, okay? And basically, they're selling you a whole bunch of stuff. The coverage is not as much of a difference as you might think. These are very mature sectors, okay? And they all have to use basically the same infrastructure. So what they do is they have very little investment opportunity. I'm sorry, but there's not so much more they can do. Most of us now have 5G networks, right? And most of us have as advanced as it's going to get until the next revolution of Starlink comes. So what these companies do is they crank up their debt levels to maximize the value of the firm, right? For their shareholders to basically maximize the return on equity. They don't need to retain, right? They don't need excess borrowing capacity, right? So what they do is they maximize the value of the firm, right? And then it maximizes return on equity because they're a more mature company and they don't have a lot of investment opportunity, right? And that's very applicable to Rogers, very applicable to Telus. That's where my phone plan is, right? So their goal is not investing and expanding; it is value maximization, right? Whereas maybe I'll go to, oh, there we go, perfect. Information technology, right? Constellation Software Inc., Discard Systems Group Inc., right? These are among the lowest, right? So in these cases, their long-term debt is only 59% of their equity. So they have a huge amount of equity. This goes to prove that they're maintaining excess borrowing capacity, right? Because they recognize that they want to maintain a lot of equity so that they can plow that income back into their operations, and they want to make sure that when more projects come up in the future, they have the excess debt available, the debt borrowing capacity to borrow more debt, right? So we notice that, higher growth firms basically are using more equity and less debt, whereas firms that have matured are using more debt to maximize shareholder value, okay? And that's kind of what this shows. So don't estimate financial distress costs, right? Avoid financial distress costs by maintaining excess borrowing capacity, right? It's kind of like your credit score. Just because you have maybe $40,000 in available, credit on your line of credit, it doesn't mean you take out $40,000 in loans on your line of credit, right? Because you're gonna have to pay interest on that, right? So not a lot of people really understand how their credit score works. But what goes into the calculation is they look at what your excess borrowing capacity is, and then they look at how much of that excess borrowing capacity that you use, right? So someone with basically $100,000 in credit granted to them, and they use all 100,000, they don't have a lot of excess. That's a high risk person, right? Just like a firm, right? If a bank's only comfortable lending you $100 million and you take the entire $100 million, right? You have become higher risk because you have to pay that interest, and there's a higher likelihood that you end up, with financial distress, right? Whereas taking this back to the example of a credit score, if you're a type of person who has credit cards, right, and you have lines of credit, but you don't use them, you just have a whole bunch of excess borrowing capacity that just sits there, and you use like 10% of that, you're going to be ranked as like super low risk. Your credit score is going to be phenomenal because they'll do a calculation. They'll say this person has $60,000 in credit, but only uses 2,000 of it, right? Everyone's willing to give them credit, but they don't have to use it, right? That's a low risk person, right? Same thing for companies. If they keep very low debt, they could take on more debt, but they don't, and they leave excess borrowing capacity. It protects against financial distress costs because they don't run into the risk where they can't make interest payments, right? Having high equity doesn't matter. You don't have to pay dividends. They have to be declared, right? Whereas interest has to be paid. And if you can't pay interest, then you run into financial distress and bankruptcy costs, right? Okay, so consider refinancing debt when rates are low. This is always a good idea, right? If you have a whole bunch of debt, say 4 or 5%, and now prime rate, hopefully it drops again, but it goes down to like 2-1%. Yeah, refinance your debt. It makes sense, right? Lock into a long term. When prime rates are high, right? You go variable rate, right? Because you're expecting that eventually the rates are going to come down and your cost of debt is also going to drop with the prime rate, right? Which is set by the bank, right? But when you're in a very low, right? So say prime rates between 1 and 2%, you lock into a fixed rate. So basically, say 3-4 years ago prior to COVID, when prime rates were super low and they were for a while, if you're going to get a mortgage, you go really, you go fixed rate basically, right? Because you want to make sure you lock in that low rate for as long as possible because you think it's gonna be steady, right? But right now, if you're gonna do a mortgage, mortgage costs are dumb, like 5.56%. About 60% of your payment on your mortgage is gonna be interest, honestly. You might as well just pay rent, to be honest with you. So what's gonna happen is you lock into a variable rate, and then when those prime rates finally come down, your mortgage interest portion is also going to come down and your principal per payment is going to increase, right? So you're building more equity per payment. So in this current market, right, you would time it, you'd refinance, and you'd basically go with a variable rate versus when it is low, you lock into a fixed rate to lock in that low cost of debt. And then capital structure theory, our view, textbook view, trade-off model and optimal capital structure, signaling theory, and summary of firms' behavior with respect to capital structure decisions. It all boils down to this, and this is the graph I've been referring to, okay? As you issue debt, okay, and this is, you know, as the debt value increases and as we issue more debt, your required return on your shares is going to increase because it increases the risk to your shareholders and it decreases net income, okay? So this is basically my cost of equity increasing, which makes total sense because risk increases, therefore my shareholders require a higher return, okay? So now, as I issue more debt, the company becomes riskier as well. Bankruptcy risk starts kicking in. So it remains pretty well flat and then it starts to increase. This is as you start getting around 50-ish%, right? And you start losing borrowing capacity. As you keep going, your cost of debt is going to start really getting high because your bankruptcy costs start really getting high and no one's going to lend you money, right? Because you have so much in interest payments, your interest coverage ratio sucks, right? And basically you're so high risk that you can only get debt for 20-30% from, say, loan sharks, right? So there's a very magical point here where, you know, your cost of debt starts to increase, right? And your weighted average cost of capital becomes optimized, right? Now, when your cost of equity starts increasing sharply and your cost of debt starts increasing sharply, your weighted average cost of capital basically is overly offset by the bankruptcy costs and it starts increasing as well as we start issuing more debt. So there's a very magical point here where the valuation of the firm is maximized, right? Because if I go beyond this point, right, my weighted average cost of capital starts increasing, the valuation of the firm starts to drop. The tax benefits are outweighed by bankruptcy costs. I become too high risk. My free cash flows are discounted too aggressively. The firm's not worth it anymore, okay? So in this case, we find this magical point where I maximize the value of the firm. My bankruptcy costs, I still have a bit of excess borrowing capacity. It's not too crazy, right? And my weighted average cost of capital is minimized. At that magical point, that's the value maximization for the firm. That is the perfect capital structure usually. In some firms that are less mature, they're going to sit back to about here-ish so that they can maintain that excess borrowing capacity, right? Whereas firms that are fully matured are going to target this, like Rogers and Telus. They're going to maximize the value of the firm by taking on the right amount of debt to maximize the return on equity without becoming too risky. It's different for different industries. It's not always going to look like this, but say telecommunications, they have higher capacity to borrow because their free cash flows are so stable, so they can afford, say, a debt to equity of like 150%, right? So capital structure, firm's optimal capital structure is a particular mix of debt and equity that maximizes stock price, and at any point in time, management has a specific target capital structure in mind. Presumably the optimal one, although this target may change over time. So we cannot precisely find the best mix of debt and equity in practice. We treat the optimal capital structure as a range, right? We're going to be somewhere between 40 and 50% of debt rather than an exact 0.45 because we know the fair market values are going to fluctuate, right? An optimal capital structure is unique for each firm depending on the situation. And then signaling theory managers know more about the firm's prospects. So basically they'll maximize the value of the current not new shareholders, and stock offerings is taken as a bad signal. So stock prices tend to fall, right? Explanation of firm's behavior. Debt should be in a firm's capital structure for tax benefits, and financial distress and agency cost place limits on debt usage as well. And then we are in the summary. So this pretty much covers all of the capital structure theories. We are doing fairly good on time. So I'm going to call it there for the slideshow at least, and I'm going to basically shut down the recording. I'll do that right now. So thank you for watching this, for anyone who's watching this virtually. really appreciate your time. Sorry for the slight confusion up there, but luckily one of my students helped bail me out and I had to explain it more thoroughly, so thank you. And I'll shut down the recording now.